So we're going to start in chapter 1, of course, and really think about why we need insurance. Why do we have insurance, and the whole just concept of insurance. And really it's so that we're not out of pocket. If something bad happens, we want to make sure that we can get it replaced, or we get the money and we're not left without something. And insurance is called a risk transfer mechanism. So we're transferring our risk to somebody else. So there's a risk that I'll lose my mobile phone. I don't want to pay for a new one because it costs a lot of money. So I'm going to transfer that risk to an insurer and insure my phone. Just let someone else in. So there's a number of ways that we see the word risk being used in insurance. Okay, so you might see it used in different ways. So it could be, the risk could be the thing that we're insuring. It could be the risks that are associated with the thing that we're insuring. But generally, the word risk means the chance of something, or the possibility of something unfortunate happening, an unfortunate occurrence, doubt concerning the outcome of a situation, or unpredictability. But with risk, we can also have the chance of a gain as well. You know, when we put the lottery on, there's always a chance that we're not going to get that £2 back, or however much it is for a lottery ticket these days. However, there's a chance, there's a risk that we might win the lottery as well. It doesn't happen very often to people, but you know, there is still a chance there. There's still a risk. And when we consider risk, an insurer is going to look at the components of the risk. So they're going to look at what it is that could occur. So is it theft? Is it fire? These are perils and hazards. What's the probability that these things can occur? What's the likelihood, and what's the impact if those things do happen? And what are the consequences going to be? And insurers look at frequency and severity as well. And this is how they sort of rate policies. So for example, if we take the example of a windscreen claim, the frequency and severity for that is, the frequency is high and the severity is low. So this means that this thing happens all the time. People are always getting chipped windscreens. However, the cost of it is quite low. So high frequency, low severity. So we're going to look as well at how we can categorize risks. So in insurance, we've got financial and non-financial risks. So first of all, we'll look at financial risks. So for something to be insurable, it has to be measurable in financial terms. So things like damage or theft, we can measure this in financially. Non-financial is, well, what it says on the tin. This is where the outcome can't be measured financially. So this could be like the loss of enjoyment of a holiday. So you can't claim from your travel insurance if you didn't enjoy your holiday, because how can we measure that in financial terms? Whereas if our car gets stolen, we can easily put a price on that. The next is pure and speculative risks. So a pure risk is what we typically insure day to day. It's where there's only a chance of a loss, but not of a gain. Okay. The best that we can achieve is a break-even situation. I go out in my car to go to Aldi. That's what I do generally. The best that can happen to me is that I get there in one piece, yeah, or I can suffer a loss. I can either break even or have an accident where I suffer a loss. With speculative risk, so that's the uninsurable risk, they're uninsurable because they're associated with gambling. So you can lose, you can break even, or you can make a gain. So we mentioned a minute ago about the lottery. You can't insure yourself against not winning the lottery, because you might win the lottery. Okay. So if you insure that, there's a chance that you lose, break even, or you make a gain. And those are uninsurable risks. And the last risk category is particular and fundamental. So a particular risk is insurable because it's very localized in its cause and effect. It only affects a certain area. So if you think about a car accident, that will affect maybe 2, 3, 4 people, just a small group. It's not widespread across, you know, a whole area. Whereas the opposite of that is a fundamental risk. This is uninsurable. This is because it affects a really large area, a large group of people, and the effects of it are very widespread. And it's outside of anybody's control. And this is where we see risks that are arising from like social, economic, political, or natural causes. So we're thinking like war, an earthquake. Okay, so fundamental risks are uninsurable. So fund it would be mental. I've got a few weird ways to remember things, which I'll tell you about as we go through. Hopefully it might stick in your mind, who knows. So the last thing on here is pooling of risk. So the basic principle of insurance is that all of the premiums pay for the losses. So the losses of the few are met by the contributions of many. And I think of like a big swimming pool full of money. That'd be nice, wouldn't it? We all pay our premiums into this pool that the insurers have. The insurers have to keep that pool full. And then when there's a claim, that's where the claims come out of. And we all have to pay an equitable premium into the common pool. And the word equitable just means fair. A fair premium for the risk that we bring to that pool. So bad driver, loads of convictions, good driver, no convictions. It's only fair that the bad driver pays more than the good driver. Okay, because they're more likely to take money out of the pool. So they should put more in. That's the concept of the common pool and the pooling of risks. Okay. So next thing, chapter 1 looks at risk management. So businesses and even insurance companies as well, they need to manage their risk. They'll look at trying to reduce potential for losses by managing their hazards. That allows them to give their shareholders confidence in the business, and it helps them as well to reduce their insurance, because businesses need insurance as well. So when we identify risks, this involves sort of looking for the threats that exist and maybe even ones that might happen in the future as well. Not all risks are going to be insured, but you can still manage those risks. After we've identified the risks, we're then going to analyze the risks. So within risk analysis, the risk managers are going to look at past data, perhaps, to look for patterns, which is then going to help them predict what's going to happen in the future. And then lastly, if a risk is risky enough, so to speak, there should be something put in place to try and control that risk. That's where we get the risk control. So we want to try and reduce it or eliminate it entirely. Okay, so this could be like installing an alarm to your house. So that would be a physical measure. So that's something that you physically do. Put an alarm on the house, put bars on the window. Or we can implement financial measures. So a financial measure would be me taking out contents insurance. I've done the physical measure by putting an alarm on my house, and I've done a financial measure by taking out insurance. So those are the controls that we can put in place to try and minimize or eliminate risk. Okay. So next, looking at co-insurance, self-insurance. So insurers, we spoke a minute ago about that pool of money that we've got and how they need to keep that pool full. Okay, and insurers really need to manage that pool of money, because that's where the claims are paid from, and they want to be able to meet all of the claims that come in. So insurers are going to decide what's an acceptable risk for them to take on and what's not an acceptable risk. And if an insurer gets a risk that's a bit outside of its comfort zone, outside of its acceptance criteria, then the insurer can decline the risk. Of course, we don't want to cover that, or they can find a way of sharing it with somebody else. And that's when we look at co-insurance.